Welcome to this exam review from Birdsy, your AI-powered study partner. Be sure to like and subscribe for more videos, and don't miss what's happening in the lower corner of the screen. It could be just the thing you need to pass your exam. Let's get started.
Let's start by taking a look at the fundamentals of real estate financing. Basic financing concepts and terms. What is the primary purpose of a promissory note in real estate financing? Is it A, to transfer property ownership, B, to serve as evidence of the debt, C, to determine property value, or D, to secure the loan with collateral? The answer is B, to serve as evidence of the debt. A promissory note is a written promise to pay a specified amount of money at a certain time. It serves as evidence of the debt and outlines the terms of repayment. What does the term amortization refer to in real estate financing? Is it A, the initial loan amount, B, the interest rate on a loan, C, the process of paying off a loan over time, or D, the total interest paid over the loan term? The answer is C, the process of paying off a loan over time. Amortization is the process of paying off a debt over time through regular payments. These payments cover both principal and interest.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
In real estate financing, what is an escrow account primarily used for? Is it A, holding funds for taxes and insurance, B, securing the loan with collateral, C, calculating interest payments, or D, determining loan eligibility? The answer is A, holding funds for taxes and insurance. An escrow account holds funds for property taxes and insurance, ensuring these expenses are paid on time by the lender on behalf of the borrower. A borrower is considering a fixed-rate mortgage. What is the main advantage of this type of loan? Is it A, lower initial interest rates, B, stable monthly payments, C, flexible payment terms, or D, no down payment required? The answer is B, stable monthly payments. A fixed-rate mortgage offers stable monthly payments, which helps borrowers budget effectively without worrying about interest rate fluctuations. Which term describes the interest rate that banks charge each other for overnight loans? Is it A, B, discount rate, C, LIBOR, or D, federal funds rate? The answer is D, federal funds rate. Why this question may seem a bit tricky. The term prime rate is often confused with federal funds rate, but the federal funds rate is the correct term for interbank overnight loans. In real estate financing, what does the term LTV ratio stand for? Is it A, loan-to-volume ratio, B, loan-to-vendor ratio, C, loan-to-venture ratio, or D, loan-to-value ratio? The answer is D, loan-to-value ratio. Why this question may seem a bit tricky. LTV ratio stands for loan-to-value ratio, which is a common term in real estate financing. It measures the loan amount against the appraised value of the property, not the purchase price or loan interest rate. Promissory notes, mortgages, and deeds of trust. What is the primary purpose of a promissory note in real estate transactions? Is it A, to serve as a borrower's promise to repay a loan, B, to transfer ownership of property, C, to outline the terms of a lease agreement, or D, to provide insurance coverage for a property? The answer is A, to serve as a borrower's promise to repay a loan. A promissory note serves as a written promise to repay a specified amount of money, typically with interest, under agreed terms. It is a key document in real estate financing. Which document secures a loan with the borrower's property as collateral? Is it A, promissory note, B, mortgage, C, deed of trust, or D, lease agreement? The answer is B, mortgage. A mortgage is a legal agreement that secures a loan by using the borrower's property as collateral, ensuring the lender can claim the property if the loan is not repaid. A borrower defaults on their mortgage. What legal process allows the lender to claim the property? Is it A, refinancing, B, short sale, C, foreclosure, or D, eviction? The answer is C, foreclosure. Foreclosure is the legal process by which a lender can claim ownership of a property when the borrower defaults on their mortgage payments. In a deed of trust, who holds the title to the property until the loan is paid off? Is it A, borrower, B, lender, C, escrow agent, or D, trustee? The answer is D, trustee. Why this question may seem a bit tricky. The trustee holds the title, not the lender or borrower. This can be confusing, as the lender is often thought to hold the title. What is the role of a trustee in a deed of trust? Is it A, to provide the loan funds, B, to hold the title and manage foreclosure if necessary, C, to insure the property, or D, to collect monthly payments? The answer is B, to hold the title and manage foreclosure if necessary. The trustee holds the legal title to the property and is responsible for transferring it to the lender if the borrower defaults. What is the primary function of a mortgage in real estate financing? Is it A, to transfer property ownership, B, to secure a loan with real property, C, to determine property value, or D, to calculate interest rates? The answer is B, to secure a loan with real property. A mortgage is a legal agreement that uses real property as collateral for a loan. It ensures the lender can claim the property if the borrower defaults. A homeowner has a deed of trust with a lender. If the homeowner defaults, who initiates the foreclosure process? Is it A, the borrower, B, the lender, C, the trustee, or D, the county recorder? The answer is C, the trustee. In a deed of trust, the trustee holds the title and initiates foreclosure if the borrower defaults, acting on behalf of the lender. In a promissory note, what is the borrower's obligation if the note includes an acceleration clause? Is it A, to pay the next installment early, B, to renegotiate the loan terms, C, to pay a penalty fee, or D, to pay the entire loan balance immediately? The answer is D, to pay the entire loan balance immediately. Why this question may seem a bit tricky, an acceleration clause requires the borrower to pay the entire loan balance immediately upon default, not just the missed payment.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Loan origination and underwriting process. What is the primary purpose of the loan origination process in real estate financing? Is it A, to sell real estate properties, B, to evaluate and process a borrower's application, C, to determine property value, or D, to finalize loan closing? The answer is B, to evaluate and process a borrower's application. The primary purpose of loan origination is to evaluate and process a borrower's application to determine their eligibility for a mortgage loan. Which document is typically required during the loan underwriting process to verify a borrower's income? Is it A, credit report, B, property deed, C, pay stubs, or D, title insurance? The answer is C, pay stubs. Pay stubs are commonly used to verify a borrower's income during the underwriting process. What does the term loan-to-value ratio refer to in real estate financing? Is it A, the ratio of the loan amount to the property's appraised value, B, the ratio of the property's value to the loan interest rate, C, the ratio of the borrower's income to the loan amount, or D, the ratio of the loan term to the property's age? The answer is A, the ratio of the loan amount to the property's appraised value. The loan-to-value ratio measures the loan amount against the appraised value of the property. A borrower with a stable job history and excellent credit applies for a mortgage. What aspect of the underwriting process will most likely be straightforward for this borrower? Is it A, property appraisal, B, title search, C, income verification, or D, creditworthiness assessment? The answer is D, creditworthiness assessment. With a stable job history and excellent credit, the creditworthiness assessment will likely be straightforward. In the loan underwriting process, which factor is least likely to affect the approval of a mortgage loan? Is it A, borrower's credit score, B, choice of real estate agent, C, borrower's income stability, or D, property appraisal value? The answer is B, choice of real estate agent. Why this question may seem a bit tricky. All factors are important, but the borrower's choice of real estate agent is least relevant to loan approval. In the loan origination process, which factor is most likely to be misinterpreted as a guarantee of loan approval? Is it A, credit score, B, pre-approval, C, down payment, or D, employment history? The answer is B, pre-approval. Why this question may seem a bit tricky. Pre-approval is often mistaken for a guarantee of loan approval, but it is only an initial assessment. Final approval depends on a thorough underwriting process. Types of real estate loans. Conventional loans and private financing. What is a key characteristic of a conventional real estate loan? Is it A, not insured by the government, B, guaranteed by the government, C, only available to first-time buyers, or D, require no down payment? The answer is A, not insured by the government. Conventional loans are not insured or guaranteed by the government. Unlike FHA or VA loans, they are typically offered by private lenders. Which of the following is typically a requirement for obtaining a conventional loan? Is it A, government insurance, B, higher credit score, C, no income verification, or D, zero closing costs? The answer is B, higher credit score. Conventional loans often require a higher credit score compared to government-backed loans, reflecting the lender's risk assessment. A buyer is considering a private financing option because they have a low credit score. What is a potential advantage of private financing in this situation? Is it A, lower interest rates, B, government backing, C, flexible credit requirements, or D, no need for a down payment? The answer is C, flexible credit requirements. Private financing can be more flexible with credit requirements, making it accessible for those with lower credit scores. In private financing, which factor might lead to higher interest rates compared to conventional loans? Is it A, government regulations, B, lower lender risk, C, government insurance, or D, higher lender risk? The answer is D, higher lender risk. Why this question may seem a bit tricky. Private financing often involves higher risk for lenders, leading to higher interest rates. This is not due to government regulations or insurance. What is a common feature of private financing in real estate? Is it A, standardized terms, B, customized terms, C, government oversight, or D, fixed interest rates? The answer is B, customized terms. Private financing often involves direct negotiation between the borrower and the lender, allowing for customized terms. FHA, VA, and USDA government-backed loans. What is a key benefit of an FHA loan? Is it A, lower down payment requirements, B, no mortgage insurance, C, available only to veterans, or D, no credit check required? The answer is A, lower down payment requirements. FHA loans are popular for their lower down payment requirements, making homeownership more accessible to buyers with limited funds. Which government-backed loan is specifically designed for rural property buyers? Is it A, FHA loan, B, VA loan, C, USDA loan, or D, conventional loan? The answer is C, USDA loan. USDA loans are intended to help low to moderate income buyers purchase homes in rural areas. Who is eligible for a VA loan? Is it A, anyone buying a home, B, veterans and active duty service members, C, first-time home buyers only, or D, low-income families? The answer is B, veterans and active duty service members. VA loans are available to veterans, active duty service members, and some members of the National Guard and Reserves. John, a veteran, wants to buy a home with no down payment. Which loan should he consider? Is it A, FHA loan, B, USDA loan, C, conventional loan, or D, VA loan? The answer is D, VA loan. VA loans allow eligible veterans to purchase homes with no down payment, making them ideal for John's situation. Which loan type requires an upfront mortgage insurance premium? Is it A, VA loan, B, FHA loan, C, USDA loan, or D, conventional loan? The answer is B, FHA loan. Why this question may seem a bit tricky. Both FHA and USDA loans involve mortgage insurance, but only FHA requires an upfront premium. Which government-backed loan program allows for the purchase of a home with no down payment, but is only available to eligible veterans? Is it A, FHA loan, B, VA loan, C, USDA loan, or D, conventional loan? The answer is B, VA loan. Why this question may seem a bit tricky. The no down payment feature is common to both VA and USDA loans, but only VA loans are specifically for veterans.
Finding this helpful? Hit like and subscribe so you'll be the first to see new exam prep videos on the topics you need to master, all with Birdsy, your AI-powered study partner.
Adjustable rate, interest only, and balloon loans. What is a key characteristic of an adjustable rate mortgage? Is it A, the interest rate can change periodically, B, the interest rate is fixed for the entire loan term, C, the loan is interest only for the entire term, or D, the loan must be paid off in full at the end of the term? The answer is A, the interest rate can change periodically. An adjustable rate mortgage features an interest rate that can change periodically based on an index. This means the monthly payments can increase or decrease over time. What happens at the end of the interest-only period in an interest-only loan? Is it A, The loan is automatically refinanced. B. The borrower starts paying both principal and interest. C. The loan is fully paid off. Or D. The interest rate becomes fixed. The answer is B. The borrower starts paying both principal and interest. At the end of the interest-only period, the borrower must begin paying both principal and interest, which usually results in higher monthly payments. A borrower has a balloon loan that requires a lump sum payment at the end of the term. What must the borrower do to avoid default? Is it A. Continue making regular monthly payments? B. Request a loan modification? C. Refinance the loan or pay the lump sum? Or D. Ignore the lump sum payment? The answer is C. Refinance the loan or pay the lump sum. To avoid default, the borrower must either refinance the loan, sell the property, or pay the lump sum due at the end of the term. Which loan type might initially seem affordable due to low payments, but can lead to payment shock? Is it A. Fixed-rate mortgage? B. Balloon loan? C. Interest-only loan? Or D. Adjustable-rate mortgage? The answer is D. Adjustable-rate mortgage. Why this question may seem a bit tricky. Interest-only loans and ARMs both have low initial payments, but ARMs can lead to payment shock when rates adjust. Financing calculations and costs. Loan-to-value ratios and discount points. What is the primary purpose of calculating the loan-to-value ratio in real estate financing? Is it A. To determine the interest rate for the loan? B. To assess the risk of the loan? C. To calculate monthly mortgage payments? Or D. To set the loan term? The answer is B. To assess the risk of the loan. The LTV ratio helps lenders assess the risk of a loan by comparing the loan amount to the appraised value of the property. How does a higher loan-to-value ratio affect a borrower's mortgage insurance requirements? Is it A. It eliminates the need for mortgage insurance? B. It reduces the cost of mortgage insurance? C. It increases the likelihood of requiring mortgage insurance? Or D. It has no effect on mortgage insurance requirements? The answer is C. It increases the likelihood of requiring mortgage insurance. A higher LTV ratio typically means the borrower is required to pay for mortgage insurance to protect the lender against default. What is the effect of discount points on a mortgage loan? Is it A. They lower the interest rate on the loan? B. They increase the loan amount? C. They extend the loan term? Or D. They eliminate the need for a down payment? The answer is A. They lower the interest rate on the loan. Discount points are prepaid interest that reduce the interest rate on a mortgage, lowering monthly payments over the loan term. A borrower is purchasing a home valued at $200,000 with a loan of $160,000. What is the loan-to-value ratio? Is it A. 60%? B. 70%? C. 75%? Or D. 80%? The answer is D. 80%. The LTV ratio is calculated by dividing the loan amount by the property value. Here, $160,000 divided by $200,000 equals 0.8, or 80%. If a lender offers a borrower a lower interest rate in exchange for purchasing discount points, what is the borrower effectively doing? Is it A. Increasing the loan term? B. Prepaying interest to lower the rate? C. Reducing the loan principal? Or D. Eliminating the need for a down payment? The answer is B. Prepaying interest to lower the rate. Why this question may seem a bit tricky. The borrower is prepaying interest to reduce the loan's interest rate, which can be confused with other loan terms. Amortization, interest, and payment calculations. What is the primary purpose of amortization in a mortgage loan? Is it A, to increase the interest rate over time? B, to systematically reduce the principal balance? C, to calculate property taxes? Or D, to determine the loan's interest-only payments? The answer is B, to systematically reduce the principal balance. Amortization is the process of spreading out a loan into a series of fixed payments over time, which helps in gradually reducing the principal balance. How does a fixed-rate mortgage affect monthly payments over the loan term? Is it A, payments remain constant? B, payments increase annually? C, payments decrease over time? Or D, payments vary with market rates? The answer is A, payments remain constant. In a fixed-rate mortgage, the interest rate remains constant, resulting in stable monthly payments throughout the loan term. What happens to the interest portion of a mortgage payment over time in an amortizing loan? Is it A, it remains constant? B, it increases? C, it decreases? Or D, it fluctuates randomly? The answer is C, it decreases. In an amortizing loan, the interest portion of the payment decreases over time as the principal balance is reduced. A borrower takes a 30-year fixed-rate mortgage. How will the principal and interest components of the monthly payment change over time? Is it A, both components remain constant? B, both components increase? C, principal decreases, interest increases? Or D, principal increases, interest decreases? The answer is D, principal increases, interest decreases. In a fixed-rate mortgage, the total payment remains the same, but the principal portion increases while the interest portion decreases over time. If a borrower makes additional payments on a fixed-rate mortgage, what is the most likely effect on the loan term? Is it A, the interest rate decreases? B, a loan term shortens? C, the monthly payment decreases? Or D, the loan term lengthens? The answer is B, a loan term shortens. Why this question may seem a bit tricky. Additional payments reduce the principal faster, shortening the loan term, but do not affect the interest rate or monthly payment amount. Financing laws and regulations. Truth in Lending Act and RESPA. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates on loans? B, to ensure consumers are informed about the cost of credit? C, to provide insurance for mortgage loans? Or D, to standardize loan application processes? The answer is B, to ensure consumers are informed about the cost of credit. TILA is designed to promote informed use of consumer credit by requiring disclosures about its terms and cost. It ensures that consumers are aware of the true cost of credit. A borrower receives a loan estimate under RESPA. What must the lender ensure regarding the closing disclosure? Is it A, it is provided on the day of closing? B, it is provided 1 week after closing? C, it is provided at least 3 business days before closing? Or D, it is provided immediately after the loan estimate? The answer is C, it is provided at least 3 business days before closing. The lender must ensure the borrower receives the closing disclosure at least 3 business days before closing, allowing time to review the final loan terms. Which document is required by RESPA to be provided to the borrower within 3 business days of receiving a loan application? Is it A, loan estimate? B, closing disclosure? C, mortgage servicing disclosure statement? Or D, annual escrow statement? The answer is A, loan estimate. The loan estimate must be provided within 3 business days of receiving a loan application, detailing the estimated costs of the loan. Under TILA, which of the following is not required to be disclosed to the borrower? Is it A, annual percentage rate, B, total of payments, C, finance charge, or D, borrower's credit score? The answer is D, borrower's credit score. Why this question may seem a bit tricky, TILA requires disclosure of finance charges, APR, and total payments. The borrower's credit score is not a TILA requirement. Equal Credit Opportunity Act and fair lending. What is the primary purpose of the Equal Credit Opportunity Act? Is it A, to prevent discrimination in credit transactions, B, to regulate interest rates on loans, C, to provide financial education to consumers, or D, to enforce banking regulations? The answer is A, to prevent discrimination in credit transactions. The ECOA aims to prevent discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, or age. A lender denies a loan application because the applicant is 70 years old. How does this action relate to the ECOA? Is it A, it is compliant with the ECOA, B, it is unrelated to the ECOA, C, it violates the ECOA, or D, it is a standard lending practice? The answer is C, it violates the ECOA. The ECOA prohibits discrimination based on age, so denying a loan solely due to age is a violation. Under the ECOA, which of the following is not a protected class from credit discrimination? Is it A, race, B, marital status, C, age, or D, employment status? The answer is D, employment status. Why this question may seem a bit tricky. The ECOA protects against discrimination based on race, color, religion, national origin, sex, marital status, and age, but not employment status. Predatory lending and consumer protections. What is a common characteristic of predatory lending practices? Is it A, charging excessive fees and interest rates, B, offering loans only to high-income individuals, C, providing clear and transparent loan terms, or D, requiring a high credit score for loan approval? The answer is A, charging excessive fees and interest rates. Predatory lending often involves high fees and interest rates that are not justified by the borrower's credit risk, exploiting the borrower's lack of understanding. A borrower is offered a loan with terms that include a balloon payment at the end. What should the borrower be cautious about in this situation? Is it A, the initial interest rate, B, the length of the loan term, C, the large final payment required, or D, the lender's reputation? The answer is C, the large final payment required. Balloon payments can be risky as they require a large sum at the end of the loan term, which may be difficult for the borrower to pay. Which of the following is not typically considered a predatory lending practice? Is it A, loan flipping, B, equity stripping, C, packing unnecessary insurance, or D, offering high-interest loans with clear terms? The answer is D, offering high-interest loans with clear terms. Why this question may seem a bit tricky. The term predatory lending can be broad, but not all high-interest loans are predatory if they are transparent and justified by risk.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.